and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us. Let's check what's going on at a macro level. US Treasury yields moving higher after a sharp rebound in US home building last month, which further underlined the resilient economy there, adding to the prospect that interest rates will stay at elevated levels. Single-family housing starts, which account for the bulk of home building, increased 3.2%. And the Federal Reserve's Beige Book has indicated that US economic activity was little changed over the past month and a half as the labour market tightness continued to ease and prices continued to increase at a modest pace. Meanwhile, New York Fed President John Williams has said interest rates will need to stay high for a while, saying right now we need to keep this restrictive stance of policy in place for some time to get inflation down. Well, the yield on the 10-year Treasury note rose to 4.87% after earlier coming close to setting a fresh 16-year high, while the 2-year yield eased too close to 5.2%. And the US dollar rose against most major currencies as investors watch for signs of the war between Hamas and Israel. In his visit to Israel, US President Joe Biden has pledged solidarity with the country and more aid, while saying a deadly blast at a Gaza hospital seemed to have been caused by a rocket misfired by militants. He also promised $100 million in new funding for humanitarian aid to Palestinians in Gaza and the Israeli-occupied West Bank. The Aussie dollar currently trading down around 0.5% at 63.4 US cents. Well, so the market seemingly has woken up to the reality that the inflation war is not over. What's that mean for investors? Sam Ruiz joining us from T. Rowe Price. Sam, good to see you.
Good to be back, Andrew.
Well, in fact, we just had that quote there from John Williams saying this is where rates need to be for some time. You look at inflation at the moment. Now, of course, we've got the prospect that oil prices are going to continue to march higher, and that's certainly going to have an inflationary effect.
Absolutely. It's really good timing to come back. I feel like we're a broken record because it's been about 12 months where we've been warning investors that the inflation battle is going to be harder than a lot of people expect. And I think if we go back to why the market has become a little bit complacent up until about 6 weeks ago and became comfortable enough to look through the inflation battle was we had inflation go from 9% down to about 3% at the most recent June result. That's now already started to reaccelerate up towards 4%. So we do think there's some underlying factors. The labour market's easing a bit, but it's still actually really tight. We're at pretty much full employment. But you mentioned a real critical one. There's a big theme of deglobalization and onshoring we're aware of, but energy particularly, we're actually seeing some worrying signs, not just because of some of the wars we're seeing, but we think we've reached peak productivity in oil, and we think that the underinvestment is actually meaning we're going to see higher oil prices for longer.
How do you think central banks are going to play this? I mean, that comes out in the headline number. They tend to focus on core, which strips out, food and energy. But it's undeniable of the effects that this is going to have, particularly given the likelihood we'll get an escalation of that conflict in the Middle East.
Absolutely. So you talk about core versus headline. I think there's two other components that the central banks are looking at, particularly the Fed, and that's services versus goods inflation. So services inflation is still very sticky. There is a tug of war at the moment in services inflation between shelter and then you've got wages as well. Now, wages is not really budging that much. We've got the shelter inflation coming down, but it's all these components as they work in unison we think are actually going to aggregate to a higher inflation rate. We're not going back to this 2% target quickly. What that means, and this is what we've been calling for, is this higher for longer inflation environment, but also rates environment. And you quoted a number there. I was just on Bloomberg before coming over here. It actually was around 4.91% on the US 10-year. So these are at levels that are very extreme. And when I match that back to what that means for global equities, when I look back to the multiples or the valuations the global market's trading on at the moment, they're at levels that at least over the last 7 years are associated with rates of around 2.5%. But now we're very close to 5. So something feels a little bit broken here, and there's still a little bit more water to go under the bridge if investors start to really buy into this is a very different environment to what we've witnessed for the past 10, 15 years.
So what does the investor need to watch for when we take a look at equities, and particularly we are, of course, now into earnings season in the States. Clearly a close eye will be on guidance at this point.
It will be on guidance. I think that we have had underlying a lot of resilience, and part of that's been because of this consumer cash narrative around people just have too much money. I think people will be watching for margins, so which industry sectors or companies can or can't protect margins with higher input costs, because there's only so many times you can pass it on to the consumer until they react. And on that point, I think the market will be looking for any signs that the consumer is really starting to roll over, because that's been, at least in the US, the very big determinant of why we've continued to have such resilience and people can keep spending, and that's been buoying inflation. The one point I'll make just to distinguish here though is one thing that is really unique about this cycle is that we actually have desynchronized globally. So I think a lot of investors are struggling with how would I have played this over the last, cyclical cycles of the last 70, 80, 90 years. What we have now is regionally very countries and regions are beating to very different sounds of drums. So we have China that's quite weak. We've got China that's US that's quite resilient. Europe is actually quite weak. And underlying that, we have industries and sectors where the recessions or the cyclical peaks and troughs are rolling at different times. That makes this really complex. It's not just about how you play inflation, but then how tactical you can be around where you're actually seeing earnings or fundamentals trough in some parts of the market, but peak in the other areas of the market. And that's very, very difficult, as you can imagine, how you time that and how tactical you need to be as you switch within your portfolio.
All right, well, let's talk strategy then, how you do play this. And I think you've made the point that, in the past, over the past decade or so, we have afforded to be quite offensive in our outlook, but that is now clearly switched to a more defensive play, if you like. What's the strategy then?
Yeah, so we have this saying, it's not the nicest saying, but for the last 10, 15 years, stock picking for a lot of people has been like shooting fish in a barrel. When interest rates are doing what they're doing, just buy the sexiest company with the best narrative. If they miss earnings or if they disappoint a bit, the valuations don't really get hit that much. In this world where there's a lot of opportunity cost and there's high risk-free rates and investors can put their money risk-free somewhere else, we think companies will be held to account more quickly and more aggressively. So there are opportunities to play offense, but we think investors now, for the next, at least the medium term, need to really incorporate this defensive anchor and blend the two in their portfolio, ultimately have a lot more balance. Now we're thinking about how we do that. There's still some great offensive idiosyncratic ideas in the portfolio, but then we also have to think about how you can also protect against some of the scenarios or warning signs on the horizon at the moment.
All right, you mentioned those idiosyncratic winners then. What's an example?
So they are very hard to come by at the moment, as I'm sure you can imagine. One that a lot of people have heard of, but I'll call it out just because there's question marks around the valuation of the company, is Eli Lilly. If you haven't heard of Eli Lilly, there's basically two companies that are producing these miracle weight loss drugs. So they're called the GLP-1s. Eli Lilly and Novo Nordisk basically produce these. Lilly is an exceptional company, and I'll give you a few anecdotes and examples here. They've got a really strong late-stage pipeline in drugs in Alzheimer's, in leukemia, dermatitis, etc. But these GLP-1s and the weight loss drugs we're seeing are truly transformational. There's around 4.5 million people in the US using these at the moment, but the addressable market for obesity, in our view, is around 140 million. And it's very, very capacity constrained. So basically, they can charge whatever they want. There's way more demand versus supply. But why we like Eli Lilly particularly is they're actually leading in terms of producing what is now an injectable GLP-1 drug, but they will be doing it via an oral tablet. So that's going to allow them to produce much more supply into a world that's really in high demand of these drugs. And it's almost comical when you read the headlines. Apparently it's curing chronic kidney disease, it's going to cure sleep apnea, it's going to cure opioid addiction, it's going to cure alcohol addiction. This is something that we think is a multi-decade opportunity, and it's going to be really hard even for generic suppliers to have the capacity or the budgets to even manufacture these. The final point I'll make is this is not just an opportunity, but it's entirely disrupting the market right now. We've seen ResMed, but where then do you go in your defensive bucket? And one thing that these drugs are disrupting are traditional staples. So it is remarkable now, people have big question marks on Pepsi, saying if these GLP-1s are going to limit calorie intake by 20 to 25%, what does that mean for chip consumption? What does that mean for soda consumption? People are even arguing, what does that mean for the commodity of aluminium if people are going to be consuming less soda or alcohol in cans and we need less cans in the economy? It's really starting to distort things.
Yeah, sounds like a wonder drug, but maybe it's too good to be true. We shall soon find out, I guess. Well, maybe not soon, but eventually. Just in terms of energy, where's your focus at the moment? Because we've just spoken about those oil prices, the likelihood they're going to go higher. Where are you looking at the moment?
Yeah, so offense, we're trying to find idiosyncratic ideas. In defense, one area of defense we think investors need to think about is how you hedge inflation, if inflation is indeed higher. Now, I've mentioned earlier, we think that we're going to see cost curves move structurally higher because the cost of energy is going to become more expensive to get out the ground. That means we believe we're going into a really strong capex cycle, both in the US, which a lot of people focus on, but particularly and more strongly in the Middle East. So one of our biggest exposures we have at the moment is if there's going to be a lot more capex and the complexity of basically building out more supply is higher today, who can win? And we've got a big position in the picks and shovels of oil services, so basically doing the contracting and helping these companies build out the infrastructure, and that's Schlumberger. So Schlumberger is the world's largest oil services provider, but they've got a very dominant market share, particularly offshore and in the Middle East. And we think, as I mentioned, Middle East is going to see the most capex, at least for the next 3 to 4 years, as they try to fill the hole or the undersupply where the US is actually starting to fall behind.
Sam, almost out of time. Just quickly, just taking a look at slower growth, durable stocks. What's your pick?
Yeah, durable stocks for us, it used to be staples, it used to be defensives. GLP-1s have an overhang on staples at the moment. Utilities are actually quite impaired or impacted now with high rates. For us, we're thinking about companies that can durably grow in a really weak, slower growing economy. For us, we have a position in Linde. Linde is the world's largest industrial gases supplier, oxygen, nitrogen, hydrogen, organically growing 3 to 4%. There's some other things the company is doing we think can get to around 10% growth rates. But the final thing that gives us confidence, a really strong structural growth in decarbonisation and clean energy. So when a lot of the companies have mandates to decarbonise, when governments are giving incentives for companies to decarbonise, they're a big provider in hydrogen, but also carbon capture. So that for us is at least a $50 billion opportunity over the long term for a company that's only producing around $35 billion of revenues today.
Sam, thanks so much for giving us a view of your strategy there at T. Rowe Price.
Thanks, Andrew.
All right, that is the Global View. Stay with us. The Open is just a minute away.